Gold is on the lips of everybody, every investor, every housewife, every house husband, every party people are talking about the soaring gold prices. Whether it is a good time to buy gold or whether it's time to wait and purchase when there is a correction.
Those who have invested are actually quite happy, and those who have not invested are kind of feeling that they have missed out and whether they should be investing in gold.
Should silver also have its own place in the portfolio other than just gold?
Not having bullion in your portfolio implies you are missing out on something.
So, Manoj, gold is on the lips of everybody, every investor, every housewife, every house husband, every party people are talking about the soaring gold prices and whether it is a good time to buy gold or whether it's time to wait and purchase when there is a correction. So let's step back and look at the trajectory of gold vis-a-vis the equity markets, best represented by the Nifty index, and see how things have panned out over the year, and and let's thrash out some sort of an outlook of what we can consider over the next year or so. I mean, this is a very broad, interwoven topic with economics, geopolitics, etc., etc. So let's dive in straight and consider what's really happening.
So it's always a good time to buy gold. And if you have any doubt, ask your wife. Uh, Having said that, yes, there's a lot of talk going on wherever you go. People are talking about soaring gold prices. Um, and while people who buy jewelry are complaining, people who are investing are actually, those who have invested are actually quite happy, and those who have not invested are kind of feeling that they have missed out and whether they should be investing in gold. So, as you said, if you look at the history of gold, now gold is the real currency. We have created paper money for convenience purposes. So gold is the ultimate safe haven, and therefore whenever there is uncertainty, whenever there is a likelihood that your paper money might lose value, call it inflation, and inflation could be for various reasons. Geopolitical tensions is one of the reasons why you fear prices going up, inflation happening, and therefore you take refuge in something which protects you from these kind of scenarios. And therefore, it has been a best practice. All investment advisors agree to having at least some allocation to gold in your portfolio.
Good point. So usually, right, 5 to 10% is what we go by. Given the current circumstances, and let's talk about each one. What's happening to the central bank purchases. Of late, the Indian government also is seen as holding gold, moving a lot of gold which was outside back to India. What's happened to Russia with the Ukraine war? So the increasing amount of gold as part of reserves of meaning, it's dollar is coming down, gold is going up. So given all of this, is 5% too less? Should one go all the way up to 20%? So let's first explore the geopolitical angle of it, and come out with some tips or some high level advice that one should. Of course, this is not investment advice, but a high level approach.
Again, if you look at the geopolitical situation, it creates a lot of uncertainty. Okay, and what has happened, particularly with what is recently happening in the US, thanks to President Trump's announcements, the uncertainty levels have drastically increased. The decision to uh, penalize Russia and not honor their treasury bill or the investments in dollars have led to countries trying to reduce their dependence on the US dollar. The US dollar continues to be the principal reserve currency, the numero uno forex reserve component, but its percentage is gradually coming down because of what any sovereign nation will want to do. You don't want US to dictate your policies, and therefore countries, whether it is China or India or any other major economy, you want to reduce your dollar reserves, and the only alternative is gold, and therefore central banks are slowly increasing the extent of gold that they are holding, and that is one reason why gold prices are going up. The second, as I already mentioned, is the uncertainty part. Now, Ram, here there's something very important that we need to understand. Earlier, gold was a reasonably stable asset. You will obviously find fluctuation in prices because gold has always been traded in the US, and it's always compared to the US dollar. But of late, what has happened is that gold has increasingly become speculative. So, if you look back, when the Russia Ukraine crisis started, people expected gold to explode, but nothing of that sort happened. Gold remained more or less at similar levels. So, it was more of just like how we see expectations driving stock prices, it was expectations driving gold prices. And today, with more and more trading in gold, that one additional angle has come in, and therefore the volatility in gold has increased. So, I stick by what I stated earlier. Gold is always, an asset that you should have in your portfolio, but one needs to now stomach in the volatility that is coming in with gold. Okay, and if you're talking about gold versus equity, gold in itself, yes, we want it to be in our portfolio, but if the question is gold or equity, then it is driven by what are your investment objectives.
So we talked about how various central banks are buying up gold. In fact, one bank that does publish gold numbers monthly is China. So I mean, of course, people say we can't trust Chinese numbers, but let's go with what they are. And if you see the trend, as of June July last year, China bought as much as 60 tons of gold, and now the recent July it went down to 20 tons. So China is kind of hoarded a lot. Now they're slowly tapered on the purchases. Maybe they're purchasing through other mechanisms. Now we are hearing India is, looking to go increase the purchase. So what effect do you think that the central bank buying gold and increasing it as part of their reserves vis-a-vis the US dollar? What is its likely impact on gold?
The price of anything depends on demand and supply. Now, when a central bank is buying gold, it is not for the purpose of sale. And therefore, whatever is bought by the central bank, that means to that extent the supply has reduced. That gold is no longer available for trading in the market. Okay. So, if there is a reduction in supply, and there are other central banks also looking to buy, there are retail investors like you and me who are probably looking to increase allocation to gold. That means increase demand and reduce supply, which translates as per basic economics into higher price. So, given the scenario, the expectation will be that gold will keep going up. Now, to what extent this has already been factored in, to what extent gold prices have have already increased, and whether they'll continue to increase, is something that we will not immediately know. That will have to pan out. Okay. But if you look at the long-term trajectory, gold prices will continue to increase. When gold was 10,000 rupees, it was very difficult for someone to believe that gold will touch 20,000 rupees. And it was 25,000 rupees, it was very difficult for somebody to imagine that it would cross 50,000. Today, gold is at 110, 115,000, whatever, per tola. But so today, if someone is talking about gold touching 1,50,000 rupees, it will again look difficult. But eventually, one day gold prices may cross 1 lakh. Whether it will happen in 3 months or 3 years, we do not know. Because again, if you look at gold history, there have been periods where gold prices have just remained, stagnant. So you can have increased periods, 3 years, 4 years, with hardly any gold price change. And that is what someone who is investing in gold will have to buy into.
Now let's switch gears and talk about the other precious commodity, which is silver. Now, if you see the gold silver ratio, uh, it went up to extreme levels, and now it, from 100 it has come down to around 85. Silver is finding a lot of industrial use. There is Samsung has unveiled a new technology as which uses silver more aggressively, and the demand for silver could be 1 kg per EV battery pack. And given the number of EVs that are being sold, that translates to several tons. So,
And there is solar energy.
solar photovoltaic cells are a big source. EV electronics, other than batteries, another source. So there's a lot of stuff that's going into silver's industrial use, and the demand of silver is projected to continue to rise, and the gap between demand and supply is actually going to widen by the year 2030. In our last call on Saturday, we did talk about all of this. So should silver also have its own place in the portfolio other than just gold? I mean, that's the fundamental question here.
I feel silver should also have a place in gold, just like we don't buy one stock. Gold and silver come under the broad category of bullion. So, just like we don't buy one equity stock, we do not have to restrict ourselves to just one bullion commodity. And particularly with respect to silver, as you rightly mentioned, the increased demand and the technical aspect of the gold silver ratio, silver is likely to outperform gold. Gold, hogs the headlines because it is gold, for the emotional value, for whatever reasons. People talk about the gold and the very high numbers, and that's probably precisely the reason why silver will get more demand for someone who is trying to invest purely for the purpose of investment. Okay, buying a 100-gram gold biscuit will mean at today's price around 11,50,000 rupees. That person can buy 1 kg of silver for maybe 1/10 of the same price. And therefore, if I don't want to collect 10-gram coins and rather have 1 kg silver, and with the possibility of generating a higher return, then probably I will buy. This is for physical buyers, and we have a significant amount of people who do physical buying of gold and silver. Of course, whatever is reflected in the physical market, you see in the electronic market also. So, long story short, I won't uh, be surprised if silver outperforms gold over the near term.
Regardless, I think silver deserves a place in the portfolio,
Yes.
and especially given the solar ramp up that is going to further intensify, the EV that is further going to intensify, the 5G rollouts, even some medical applications have significant silver use. So I think we can probably wrap up this relatively short podcast with two takeaways. One is that the gold to Nifty ratio is showing that in the short term, Nifty, i.e., equities, are likely to catch up, and there could be a rotation from gold to equities. However, long term investing demands that one have good allocation to gold and buy at dips over the next few months and quarters. And silver, definitely, if there is no allocation, make some space for silver as well. And together, you want to wind up something, wrap up this conversation saying how much overall should one have the range of allocation across gold and bullion? Or there's no one size fits all?
There's no one size fits all, obviously, but see, a number around 15%. For someone who is not very bullish on bullion can restrict it to 10-12%. Somebody who is ultra optimistic can probably increase it to 18%, 20%. But not having bullion in your portfolio implies you are missing out on something. At the same time, don't go overboard, don't put 40-50% in these precious metals, because over the long term, wealth creation happens through equities, because equities means investment in business, and there's no other place that can generate greater returns than being in business. So equities continue to be my first love, but yes, I will have a soft corner for gold and silver.
Sounds good. So, on this note, on this loving note, let's wrap up this.